those type of things are not, they're fantasies for a lot of people, because unless you have $100,000 or $50,000 or $10,000 that you're just going to throw at the market and start trading, chances are you're going to lose all that, or you might get lucky a few times, which there's videos on. You can actually, it's a good thing, but it's a bad thing. Say you make 50 grand on one trade that you paid 10 grand for. So you made a $40,000 profit, right? You keep it in your trading account. You're not getting taxed on capital gains or anything like that, at least not till the end of the year. And then you're like, so either A, why'd you start trading? Do you have debt to pay off? Do you just want to make more money? Do you want to build on this? Do you want to build a retirement? Because a lot of people lost a lot of money in the 08 crash, 09, and now they're still stuck working, or the retirement's garbage, and then they're depending on a very little retirement plus Social Security, which is not really going to be that great overall, depending on their living style. If you live out of your means, you will be broke. Living in your means is something you need to control. My third book will be very detailed on all sorts of areas like that, and I will promote the crap out of it because it will have so much information that young people specifically need to know. Debt when you're younger, credit cards when you're young, buying cars when you're young, certain things like that. Anyway, one thing we'll talk about real quick is what I get asked very often about, selling options. So selling options, whether you're selling calls or selling puts, why or how can you or do you want to sell puts or calls? There's only one really good answer for this. You're protecting shares because you don't want to lose money, or you're collecting premium. What do you mean collecting premium? Well, for every buyer there's a seller, for every seller there's a buyer. That's how options work. So say I want to sell a put. I have 100 shares of FCell. Well, garbage company, this is a real situation that happened. I had FCell. I took a $15 credit for 100 shares, so I risked $100 to make $15. At that time, it was an experiment, so it was, obviously now it was kind of stupid because 15 is not really any kind of return. So anyway, protecting shares. So I sold a $1 put for 100 shares. I took $100 collateral from my account and just held it. Okay, I didn't actually own any FCell shares. The company outlook in the future was moderate, but the price literally traded 130, 140, 120, 115, 130, 120, and it stayed in a very specific range. And then it got closer to expiration. Here's the thing. I tried to rebuy this option like 10 times at, $5, even cutting myself short, and I still couldn't get it back. So it just went away. So at this point, I kind of assumed that it's going to get exercised. The option will expire and be exercised. I'll be assigned 100 shares of FCell, which was fine. And now that credit I got was my protection layer. All right, so say $100 for my 100 shares. All right, and so it cost me $100, but also I think it was $10, not 15. Sorry, so $10 credit. Now my break even is $90. Why is that? Well, it can go to 90 cents because I got a $10 credit. That's my benefit. So in the event that I thought FCell was going to go back up and I would make money, I would just hold these shares, which I knew the company was kind of crap. It's already on a massive downtrend. This was a while back, but I knew it wasn't really going to do anything. So I sold it at like 98 cents per share and just took a very, very small credit overall. But it was to see how it works. So what do you mean protecting shares? Well, protecting shares, say you have $30,000 in specific shares, instead of setting a trailing stop loss or something like that, where in theory, if the price, this is set, I've not experienced this myself, but experienced traders could probably tell you that do this often. If you have X amount of shares and a trailing stop loss is in place, or a limit, stop limit or whatever, and the price gaps down over, you're going to get the best feel wherever the price opens. And that is an issue with trailing stop losses or regular stop losses. So that's one thing I was worried about with GameStop going into earnings, holding that much shares or that large amount of money or whatever. And so to some people, that's not a lot, but so anyway, you could protect your shares by either selling calls or puts against those, collecting a premium for it. You bought the shares at say $10 a share. You got 30 grand in it. You're willing to lose a max of $1 per share, right? Because you bought it at 10, but now it's at 15. So you're willing to lose, let me rephrase that. So you bought it at 10, it's at 15, you're willing to lose $1 per share. So you're 30 grand at $14, you're done. You don't want to be in that position anymore. You want to protect those shares. So you're still making that profit and you'll still collect a premium on it. But it's going to automatically sell your shares. It will automatically be assigned at $14 per share. So now you still made your $4 per share, whatever amount of money that is for your 30 grand, and and you're protecting it, and then you collected some sort of option premium in that. So some option premiums they're very, very cheap and not seemingly worth it to risk X amount of money. There's a lot of math built into that you need to understand before you go doing this kind of thing. But the thing, why do an option or put, selling a put or whatever, to protect your shares instead of a trailing stop loss? Well, like I said, that can gap down. An option contract, that's not going to happen. You have a guarantee with an option contract, a guarantee of $14 per share, guaranteed. It's an option contract. It is yours. It is a contract. Anyway, hopefully that explains a little bit. Again, Investopedia is like my go-to place to comprehend certain things or things that I haven't looked at in a long time. It's like you might understand something really well a year ago, but if you haven't done it or messed with it since then, unless you've actively used it, you're going to slowly forget that information or confuse yourself with what you're trying to remember. Get this out of here. So hopefully that was a slight brief explanation, so you sort of understand what I'm talking about. And again, so what is the fish hook? We'll run back to that real quick. You're looking for something to sell off, like, I wouldn't say $50, but 50%, as long as it's not on a downtrend, not drop. We want it to drop. Why did it drop? Why did Ulta drop? It didn't drop 50%, but why did it drop I think it was $10, $107, we'll say $107. Why did it drop $107 and then start to swing out? Well, it started to swing out because now people are like, well, shit, it lost $100 a share. It's got to be a good time to buy it. Warren Buffett says it all the time. You know, when it's cheap, buy more. When blood in the streets, you buy, even if it's your blood, et cetera, et cetera. So we got this nice, huge drop here, right? I want to put the marker for it. We got the huge drop with Ulta, right? All right, great. So now what happens? Well, we're gonna watch, and I knew it would continue down a little more. So this is where it was like 120 off. Crap. Go back this route. So 120. All right, we're down $120 per share on Ulta, right? This is a while back. It's already built back up by now. It's only a matter of time before this happens and goes up. Why is that? Because I looked at the chart history, and every time it did it before, it sold off dramatically from an earnings report, all right? And then it hit rock bottom on a bad earnings, but guess what? It built back up. And that's exactly what we counted on, and that is exactly what happened. Now, how about the reverse fish hook? A lot of people got a lot of different names for these things, different traders, whatever. So that's an oversold situation. Now, real quick on oversold and overbought. So you have oversold. Most people tend to look at RSI, which is Relative Strength Index, and then you have overbought. Okay, overbought, normal range is at 70 and 30. Those are anything in between that is fine. But once you start getting to the outside deviations of those, I set mine at 3. I like to go farther out. I want to go at like 90 or 85 and then down to like 15 or 20. And I want to see an extremely oversold area, because the problem is when it's in a standard 75, 80 area, then sometimes stocks can just keep going. Apple's been oversold for like weeks now. Now it's at $245 a share, I think, something like that. And it's just, after it hit that one jump, it got the upgrade to $250. And you got to think, Apple's an extremely well-known company. So we did this number. All right, so now we're up here, and we're $250 price target, PT price target. And the stock was at like, I don't know, 220 or something like that. Everybody thought at 225, oh, okay, right here. Everybody thought at 225 that sucker was going to fall back down. It happened every time so far. So then it went on. Everybody was for sure, we're shorting this baby at 235, 100%. Everybody's shorting it. And they probably wear a lot of shorts. And then it did this. And now it stayed at 240, 241, 243. I think it did touch 245. I have to double check. So now you're over here, you're almost touching your price target by like $5, which is extremely awesome for Apple anyway. If you look at their return overall, it's been tremendous. So if you go back to December 18, where everything did this number, Apple was down here, I want to say it was $140 a share. So look at this return. You just made $100 per share in 1 year, period. You're at $240 a share now, give or take $1. You could have bought it down here at $140. Now, this is how real options traders make money. Long-term expectations. Who knew that in 2 years, or 1 year rather, 1 year, that Apple will be at $240 a share? Well, it is a $1 trillion market cap company, if I'm not mistaken. Excuse me. So we're looking for this to be a potential return. Now, anybody that bought here made money all the way. Now, say you bought a $200 option for November or December of this year, and this price has been just moving up the whole time. Of course, theta is going to hurt you a little bit here and there. You know, theta is the time decay. So it's going to lose slight value, but it's continuing up. So it's really canceling itself out. The delta will likely be higher anyway, and you're going to make money on this. So had you bought that option, now it's in the money at $240 a share, and you're leveraging 100 shares per contract if you didn't know that. So if you bought one contract, you're leveraging 100 shares of Apple, and that sucker went all the way to 240. Depending on what your ratio there is, your buy-in cost and all that kind of stuff, you can pretty much calculate how much of a return you would have had. So that was clear intrinsic value heading up that route. If you would have bought 240 calls, that's extrinsic for your outside. But once now it's there, say you're at 240 and now the price is at 245, you now have intrinsic value on your option. So now you're definitely making money because you're in the money. Anyway, let's see, what else? We'll talk about one more thing and I'm going to end this video. Hopefully I still got some time left. Robinhood, thank you very much. They finally have, the day that I overslept and I could have had a stop limit set on my options for TD Ameritrade and all these other places. Well, guess what Robinhood decided to do? Robinhood today just released stop losses on options, and I put it in already. I put it on United Healthcare or whatever, United Health, whatever. So now Robinhood has an option stop loss, and you can place your sell limit at the same time. So I knew something was in the works when all these other brokerages started going fee free. I'm like, all right, Robinhood's got an ace up the sleeve or a trick or something that they're going to add to make their platform better. Why is everybody going to TD Ameritrade? Why is everybody going to other places? Well, first of all, their fees sucked. So they had no choice. But a lot of people were waging and bargaining and, you know, hey, I'll put this much money if you give me these if you give me these trade fees and these option contract fees, etc. So some guys had it for like super cheap, like 75 cents or $1.25 total and stuff like that. And it's like, man, there's got to be a reason that they're doing that. They're not just trying to earn your business solely for that. They already knew that they were going to lose all this money in the future. So whatever 80, 90, $100 million that they're losing per year on trade fees, they're making it back somewhere. Don't be silly here, okay? So anyway, Robinhood, option stop losses now in effect. It's free, complete 100% free unless you're doing margin. It's $10 a month on your margin or whatever, plus your 5% fee. I love Fidelity personally. I use Active Trader Pro when I have time to get on my computer. But Webull is probably the best charting platform that I use mobilely, period. I don't like the way TD Ameritrade's app set up. I have it, I use it. I have TD Ameritrade, I have Fidelity, I have Allied Trade, I have Robinhood, Webull, and one other one, Chase Bank. You don't trade options on Chase though. But anyway, so all these other banks are doing this. So Charles Schwab announced fee free, TD Ameritrade fee free. I tweeted, I doubt it was me, but Fidelity came out and was like, yo, fine, we're joining the party, fee free. So that's awesome for me. I use them the most and everything. And now Bank of America is like, we're fee free on certain things, so which probably limits them a little bit. And Chase, I don't know what their normal fee ratio is, probably $2.95 to $6.95, but chances are they'll just waive that anyway. They give you 100 free trades just for opening an investment account right now. I didn't even put any money in it, and they started doing that. So anyway, stop losses, amazing. What is a stop loss on an option? Say you paid $100 for your option. You're willing to lose a max of $30 per option. It's going to limit sell at $70 per option. Done. It's gone. It's out of your hands. You don't have to worry about it no more. That's what makes options on these other platforms great, because you protect your money. That's why people lose so much money on options. And what that is people, will buy a contract and just leave it there. They'll just forget about it. Like, if you got a 7-month expiration, who cares? But if you bought it for next week and you just bought it and it cost you $300, the price goes against you. You're already losing money, but now it's going to expire out of the money and worthless. So an option expiring worthless has happened to me 2 times, $1,000 plus scenario each time. Very sad, but learning lesson nonetheless. I also catapulted a $3,500 profit in one day on one trade with Shopify. Beautiful. That is the single most profit I've ever made on one trade, and it was very nice. So anyway, what are we going to talk about? Buy market orders or buy limit orders? Here's the thing. I made a video about this, but apparently there's still a lot of confusion about it for anybody that follows me or watches what I do. A limit order, and I've put this on even Instagram sometimes, and my Facebook page, The Real Fish Trick Trader, The Real Fish Trick Trader, Instagram as well. If the price for the market is fluctuating up and down, up and down, up and down, you don't want to buy the highest price if it's fluctuating so drastically in the event that it just turns around and goes down. Limit orders are bread and butter. Why? Because you can set a limit order for 15 or 20% under where it's at now, and as soon as it trades sideways or makes a little move back down, say you're in calls, and it makes a little move back down, or you want to be in calls, your limit order is like a 50% chance it's going to get picked up by the end of the day. Now it might be tomorrow. The price drops down $5. You're pretty much guaranteed to get picked up that. I actually set a limit buy on some Apple calls out of the money for stupid cheap. And it was like, the current price is at 90 per contract, which is 90 cents times 100 shares, $90. 90 per contract. I had a limit sell for 45. I got filled at 15 because it gapped down so far. I ended up making a 200% return on that by I think about 2 or 3 days later. And that's how that worked. The limit buy worked in my favor 100%. And despite what people say, Robinhood gave me the best fill. They could have filled it at 45, but they filled it at 15. Why am I'm not mad. The only issue Robinhood I've ever had was the one time they locked everybody's account because apparently overpayouts of options happened. So they shut everybody's account, locked them all, so you couldn't trade. So for some people that sucked because you had options expiring or whatever. But that's why you always want to have some kind of time. That can happen in any brokerage. I made a video about that as well, or said it in a video anyway. Fidelity literally shut down on me right when I was about to make a trade for several $100s. And I planned on getting out in the first 5 minutes of the market, but guess what? Fidelity crashed. Thank God. My order did not go in, so I didn't lose that money. And my issue with that is that everybody's hating on Robinhood constantly, man. But it's a fee-free platform from the beginning. Extremely user-friendly. If you can't figure out how to use Robinhood, then you probably have an iPhone. The Android, I just like it better. It's it's not a bad platform. I mean, it's extremely built for starting traders and investors. They do pay dividends on their stocks that have dividends. All kind of things like that are actually in the brokerage. Like they just added the stop loss for options. That's a big deal. So you're going to have a lot of people that were trading these other brokerages stick with Robinhood just for that reason. So real quick, I can't get filled. I set my order and it didn't get filled. I could never get filled. If you can't get filled, it's your fault. Why is it your fault? Because either A, you put the order and just expected it to happen and just put your phone down or your computer, you went to get a bowl of cereal or you left the house, whatever you did. If you don't get filled, it's your fault. I did a market order though. Okay, well, depending on what market order you did, I know for a fact that Robinhood acts as limit orders pretty much on all their options. There is really not a market order on Robinhood for options unless you see the price, and as soon as it goes up, excuse me, as soon as that price goes up, you click it, but then it goes back down, you're going to get filled 100%. Now, if it goes up again after you already hit enter, you just need to overdo it or underdo it, right? You're getting in a position. I'm okay with losing $2 or $3 or $5, worst case scenario. But chances are I'm not going to lose that money. I'm just making sure I get in the position to make the other $150 that I'm going to make on profit. Why? If the option jumps to $150, I'm going to go ahead and make it $155. Chances are it's going to get filled between $150 and $155. If it goes down, it might get filled at $147. I don't know. But if you do that and you overshoot it and you overbuy, you're going to get the best fill. It could be $150 or $155 or whatever, or it could be anywhere in between. Well, why would you do that? That's the same thing as a fee. You're still losing money. No, I know the trade is going up. I want to be on that trade. Why would I risk not being in the trade just to save $2? You know what I mean? Does that make sense? And some of you might get mad the way I say that, but it's your fault. Don't do that. Market orders on stocks, same thing. If you put a market order in a stock that's shooting up, you might get filled $5 higher than you want to. Or it could be 10 cents. Or it could be right now because the price tricked just a little bit and went down and then you got filled at a better rate. Limit orders, limit buys, limit sells, whatever. Limit buying is very simple. Like I said, you overshoot it. If you're on Robinhood, it's very easy. You see the freaking option price at $125. You can't look at option prices the night before. That's not how it works. Now, it could. So say the option closes at $120, right? $120 per contract. And then you want to buy it at a max of $130. Well, if you go ahead and put $130 in there, there's a huge probability it's going to get filled right away at $130 or $120 or whatever the best price is at the time. If the price goes down, you'll get a little better fill than what you put. Or if the price goes up over after hours, say market earnings or something like that, and the price is up $3 or $4 or $5, putting you very close to the money or at the money, you're not going to get filled for $130. You're going to get, it's probably going to be like $160 or $180 by the time you look at it in the morning, right? Unless the price jumps up and then goes back down, then of course you'll get filled. But you want to be on the right side. There's nothing wrong with day trading options. There's nothing wrong with swing trading options. If you're swing trading anything or day trading anything, you don't have to be in the day it's expiring or 2 days it's expiring. You're getting the cheaper option there, but is it really benefiting you more to get the cheaper, shorter expiration just because you have a small account or because you don't want to risk this much amount or whatever? Because guess what? You can go out 2 weeks or 3 weeks more, get a pretty close option. Oh, well, what about Shopify? Well, Amazon. Well, yeah, those are just really expensive options. Now, how can you win with those? Well, Shopify earnings is coming up very soon. I'm going to likely open a strangle against Shopify for a very out of the money call and very out of the money put, just like I had for Tesla, because I'm expecting a massive run back to 400, or earnings is somehow not going to impress. E-commerce business is falling, which I highly doubt, and then it's going to, maybe, I don't know, revisit 260-ish, 250-ish, something like that. Hell, it could even go further because it's been at 300, 320, 330. It hit 350 the other day. I really thought that was going to continue the bull run, but that was a hard resistance apparently. So limit buys, limit sells. Understand what I just said. The price at 150. I know the price is going to go up. Like I know it. I know it in my heart that Apple is going to continue, and that sumbitch is going to be at $275, right? I'm buying I don't know. It's at $245 right now. We'll keep it real. $245 right now. I know it's going to $275. My option is for 6 weeks out, but currently the option costs $150. I don't want to miss this. Now, if the price stays the same, we could probably set a limit for $150, and we'll probably get it tomorrow. Or I could just set it at $165, but it's $15. Maybe, maybe not. And then as soon as market opens, whatever the best feel, if the price trickle down a little bit, this option premium is also going to go down. If the price goes up, the option premium goes up. Okay, so I want to buy it at 165 limit. I mean, I might not go that high. I might do 155, 158, 159. And then there's pretty much a guarantee that I'm going to get filled. Real quick, the SEC, Securities and Exchange Trade Commission, has, in fact, they have a 5-cent increment rule. Well, 5 cents, it's not a big deal. Well, actually it is. It's $5, okay? In option world, that's $5. All right, if you didn't know that, you know now. $5 and 5 cents are the same thing because times 100, you now have $5. Why is this important? Shopify, some other stocks that are popular to trade, especially smaller, $10, $15, $20 stocks, they have this 5-cent increment rule. What does that mean? That means your options go like this. It's going to cost you $5, $10, $15, $20. Well, what happens when the price is stagnant? It's going to go to like 8. You know what this does to you? You can't sell that. You have to sell it for 5 to get out. If it's at 8. If it's at 3, guess what? You're burned, son. You cannot get out of this at all. Unless your option becomes in the money. If you become in the money, or it starts to dramatically increase in your favor and then goes up this spectrum, if it goes back to 5, you can probably sell for 5. But it's still slim because it's the lowest possible you can go. Or you can go to 10 and definitely sell for 5. But what you do is just set a limit order. If it's moving dramatically, you set your limit sell at 10, 15 per contract. Break even or make money on it, whatever. And then you'll get out of it. But that 5 cent is the reason I lost on Afrida and Shopify. Each position was about $1,200, and the position expired worthless because this right here. That price moved against me just enough to kill my position, and it expired worthless. Why does an option expire worthless? Well, because it's not worth anything. Why is it not worth anything? Well, because if you're selling a contract for $10 a share on Ford, and Ford just went down to $8.50 today, is your contract going to be? Is anybody going to pay you $10 a share when they can get it at $8.50? That's the easiest way to explain it. No, they're not. What they're going to do is be like, well, how about an $8 call? I'll give you $8 per share in the event that it goes there, and that's going to work out. Because it looks like, the price is going down, it's at $8.50. Ford trades in a very beautiful range. Lowest bottom is like $6.40. Ultimate top is like $12.50. And that's a huge downtrend range. Ford's been downtrending for years now. They pay dividends and all that, but their business model has to change to evolve. Otherwise, they're going to get blown out of the water very soon. Tesla's coming up. Now, there's a lot of belief that Tesla won't even be around in a few years. It is what it is. So trade what you know. My biggest thing, a list of stocks. What kind of list of stocks? Well, like Warren Buffett says, right? He says pick 25 things. Oh, put a money sign there. 25 things, and now pick the top 5 that you want to do. 100% you have to do it before you die. Now, completely forget about these. All other 20 don't even matter. This is what you need to concentrate on. Why is that? How does that relate to stock trading? Well, what we're going to do is we're going to have a list of 20 stocks. I don't say 25, I say 20. Now you're going to pick the top 10, and then you're going to pick the top 5. Now here's your thing. You're going to always keep this pool of stocks, and you can add and subtract to it if you want. If a few stocks you don't like, you can subtract a few and then add back 3 more, to compensate. Keep your list of 20. Keep your pool to pull from. Keep it there. So you want 20, all right, and then you want to narrow it down to 10. So like I got a list that I post up. I don't really care. My top 5 currently: Roku, Shopify, SPY. Tesla just joined the top 5 because of what it's doing right now. And Ford will always be in my top 5 because I can always pretty much make money on it in a situation if I need or want to. Well, why don't you only trade Ford? Well, I like to get around a little bit on it. I don't like to be... Ford moves very slowly unless it's a bad earnings or great earnings or something, or some drastic news that causes it to go from 903. I saw when it went to 920 the other day and it trended back down to like 903, 905. I knew it was about to break 9. I should have bought some $9 puts. I would have made probably 50, 60 bucks on them real quick each, just because it went down to 850. But make you a list of stocks. If you're trading options, obviously you want them to be trading options. Long-term investing, you want to have... Don't buy 20 different stocks, buy 10 different stocks, $1,000 each. This is an example, not trading advice. If you buy 10 stocks at $1,000 each, that's $10,000 investment, right? Now, why would I do that? Why would you want to do that? Well, first of all, we need to make sure, one, they're not going out of business. They're not on a massive downtrend over the last 2 to 5 years. They have a huge business plan in exchange otherwise, like GameStop, for example. Do I really expect GameStop to go back to $50 all-time high? No, I don't. I really don't. $10, $15, $20 on crazy, speculation? Maybe. At least in a year or so. If their earnings blow through the water this, next month or whatever, then chances are the price could go back to nothing. Or if they blow through the roof, then, hey, we can see $8 real soon. Anyway, why? Pick it. $10,000. $1,000 in each stock. Now, these stocks, you're going to want something that you can get at least a few of. $1,000 is a fair amount of money per share. Now, if you get a $5 or $10, $20 stock that you're expecting to go to $30, $40, $50, then that's amazing. Now, if you get something like Apple, you're going to get 4 shares, right? Not a big deal, because I think Apple will continue to do this over time. May see the $300, $400 range in the next 5, 10 years. Could be sooner, but they were very innovative before, but, things change. Technology rapidly increases its supply and demand around the world. And I think Apple still is a strong company. Samsung is a great company, in my opinion. My investments long-term are dividend only right now. MJ Alternative ETF, and for marijuana, it's a cap. So as you see, a lot of them popping recently. They hit 18 and some change. I actually still see a downtrend. I'm waiting on that to do this before I put a lot more money into it. And then APLE is a real estate investment trust, or REIT, or REIT, however you want to say it. Those are my long-term investment, dividend only. $120 a month goes into one of the 2 of those, and they will constantly build dividends over the years. And so by the time I'm 65 years old, if I choose to pull from that pool, I plan to have $500,000 in retirement by the time I'm 40. I'm currently 31. Anyway, this video was brought to you by the Fish Hook Trader. Again, you can join us on Discord chat, TCX. It is very cheap. It's only 18 bucks a month. We would definitely appreciate your business. I do hope you learned something from this video. If not, I would be more than happy to make another one in the future on some other topics. I don't really like to make videos specifically for stocks. These just happen to get thrown in with everything. But we do appreciate your time.